Well, good evening, everybody. Some of you may have heard of Time Finance, some of you may not. Back in time, the business was called something different. It was called 1PM PLC. It rebranded at the end of 2020, and I'll take you through some of the things that we've been doing over the last 3.5 years and the progress we've made since the business was called Time Finance. There's our own disclaimer. I'm going to flick over that, but obviously if you need the wording, we do have it for you. In terms of introductions, I'm Ed Rimmer. I've been in and around lending to small businesses for nearly 30 years. It's a long time. I joined a business originally called Bibby Financial Services, part of the Bibby Line Group, private business headquartered in Liverpool, and I spent 22 years there before I moved out of that business and joined what was 1PM. I left just before COVID, came back just after COVID. In hindsight, it was quite a good time to have some time out of the business. And then we set off on our current plan. James.
Good evening, everyone. I'm James Roberts. I'm the CFO. I haven't quite got the 30 years of Ed in financial services, but I've got 25 years experience in FS. And I've been with Time Finance CFO since May 2017.
Thanks, James. So forgive me if anyone does know about this business. I'm going to take you through a little bit about what we do and who we are, but it's only really one slide, and then we'll get into the sort of the bones of what we're trying to achieve and how we're doing. So who we are and what we do. Well, we're what's called an alternative finance provider. So we're not a bank. We're not a retail deposit taker. Our job is to go and find the money from the banks as cheap as we can. Set our business up so we have low bad debts, we have as an efficient business model as possible, and out of that, as we build a lending book, comes reasonable profits. We support around 10,000 UK SMEs through our key products of asset finance and invoice finance. I'll come on to those in a moment. And we lend predominantly from our own book. Back in the days of 1PM, the business was more split between broking business out and lending off their own book. A part of our current strategy was to move as much as we could onto our own book and build our balance sheet. Having said that, we do still have the flexibility to broke deals out if they're too big for us, or they're too small, or the rates aren't quite right. We have partners in the tier 1 space and the tier 3 space that we broke some business out to. We operate in the tier 2 space. And quite differently, we have a multi-product portfolio, so we're able to offer more than one funding solution to small businesses, and I'll come on to what those are in a moment. So here we go. These are our core 2 product offerings: asset finance and invoice finance. Asset finance, we do soft and hard assets. What are those? So effectively, we provide hire purchase agreements and leasing against kit, which becomes more beneficial for cash flow purposes than people buying those assets up front. So if someone's looking to buy a piece of construction equipment, a JCB digger or a crusher, significant amounts of capex, we effectively spread the costs over 3 to 5 years and put an HP or a leasing agreement in place. Who do we work with? We get our business from finance brokers, equipment suppliers and manufacturers, and also existing client referrals. Our deal sizes can be anything from 5k up to £1 million. Our sweet spot on soft asset finance. Soft assets are those assets that don't traditionally have a residual value at the end of the lease. Hard assets typically do. We've moved more away from soft assets into hard assets, and again I'll come on to the progress that we've made in a moment. But the 2 segments of asset finance, you can see there, the softer assets are typically smaller, 15 to 20k or the likes. Hard assets are a bit bigger, 75 to 150k. We yield between 9 and 19, so better quality business yields less. Smaller, less quality business yields more. And we get our funding mainly through the British Business Bank, through a significant line that James will cover when he talks about funding, and also wholesale block funders, mainly from the challenger banks. Invoice finance is cash flow finance. It's an alternative to bank overdraft, more commonly referred to historically as factoring and invoice discounting. It can either be disclosed or confidential in terms of the customer knowing that that facility is in place. Similar to asset finance, we got our business through independent intermediaries, so brokers, insolvency practitioners, accountants, solicitors and professional firms. The deal size is a bit bigger, so anything from 50k at the smaller end up to 3.5 million at the higher end. Our sweet spot is typically between 250k to £1 million in terms of the average lend, and the yields are roughly the same depending on the size and the quality. Our funding comes from a back-to-back facility with RBS that we've had in place for over 10 years, recently renewed and increased, and James will come on to that as well. Where do we sit in the market? Well, at one end of the spectrum you have the banks, who we all know. You also have the challenger banks, the newer names in the market. Alternative finance platforms, more commonly referred to these days as fintechs. Other quoted companies such as ourselves, and then lots of smaller private businesses who are typically people that have been in the industry, work for a bigger player and set up by themselves. Where do we compete? Well, we don't really compete with the banks. They tend to be tier one. They don't really now want small businesses. They prefer to lend to businesses like us to do all the work and the service, and then we provide that service to small businesses. Banks typically are now becoming much more focused on technology and slightly bigger businesses. We do compete with the private companies, and therefore we compete very much on flexibility, speed of service and personal approach. But the one thing that we have in our favour that a lot of the private smaller businesses don't have is the range of products. The smaller businesses tend to be sort of one-trick ponies because that's what they know. They stick to the safe sort of knitting and focus on that core market. So whilst we compete with the private companies and the smaller businesses, we actually have a product set which is more synonymous with the banks. So we're not completely unique, but we are one of a smaller bunch of players in this market that has got that range of products and the ability to be fast, flexible, and focused very much on service, which small businesses do still value. We've won some awards along the way, testimony to the 150 people we have on our team in terms of the hard work that they put in and how we've positioned ourselves in the market and how the brokers and our customers and clients see us. Always nice to see. So our strategic plan update. So this was put in place when I came back into the business after COVID, so June 21. It was a 4-year plan. There was still quite a bit of uncertainty at that time because of obviously what was happening post the first 2 lockdowns. But broadly, we've done really well through the first 3 and a bit years of this plan, which I'll come on to in a moment. The 4 strands of our plan were to become a nationally recognised SME funder. Now, that was very much after rebranding the business. That's not saying that we were going to become a household name. That was focused very much on our commercial finance market and the introducers that service that market, making sure that after the days of 1 p.m, people understood who Time Finance were, what we stood for, and therefore made it easy for us to for them to refer business to us. To double our gross lending book from the low point we got to post-COVID, so from 115 million, we wanted to double it to 230 million at the end of this plan. Get the profitability back up to the run rates that we were seeing pre-COVID, so back to the previous peak of 2019 levels and then on from there. And then also, as I mentioned before, to significantly strengthen our balance sheet. Shareholder feedback at that time really pointed to favourable feedback was to focus on own book lending because ultimately the receivables book is your asset on the balance sheet. And the more that we can grow that, the more that we get the lending right at the right yields and the right arrears obviously being as low as possible and the right write-offs, the more you'll maximise profitability. So that was the final strand. So what are we achieving? So if we look at our progress for the first quarter of this last year of the 4-year plan, obviously we're rapidly approaching half year now, but these are the numbers that are in the marketplace for the first quarter. We've got the book up to 205 million, so that's from 115 million starting point, significant increase, and we've carried on increasing from the end of the financial year, which was May. That's been driven very much by a refocus on hard asset finance and invoice finance. They're the 2 elements of the product offerings that are secured lending. Effectively, if the lending goes wrong, if a company goes bust, as long as the people are not unscrupulous, then you will get your money back generally if you've got proper controls and people that know what they're doing in place. And that's proved to be the case. So around 77% now of our lending is across those two divisions. Before this plan started, it was about 48%. So the business has really transitioned into being focused on secured lending through hard asset and invoice finance. Some other metrics to mention: unearned income, so that's the income that sits within that 205 million. Effectively, as long as the businesses stay in business, that finds its way into our P&L over the life of the leases and loans that we put in place. And that's significantly increased from 14 million to 26 million from the start of the plan. Well, why is that important? Well, obviously it gives us more certainty of earnings in the future so that we can manage expectations within our shareholders more accurately. Our PBT margin, you can see as well, has increased fairly significantly from where we started the plan. 8% back in 2021, up to a very healthy 21%. And a really important metric, which James is going to talk more about, is the last one, which is arrears. Obviously, growing businesses can chase high-level turnover at the expense of profitability and arrears. That's not been the case with this business. We've managed to reduce arrears from 13% after COVID down to 5%, and it's stayed pretty consistent over the last couple of years, which we're really pleased about. So we haven't taken business on at the expense of credit quality. Some things that I'll just mention, I'm not going to mention every one of these points, obviously with time in mind. The focus on the core business, I've mentioned already. We did have 7 offices at one point. We've slimmed those back to 4, 2 in the north, 2 in the south. We exited some non-core businesses that weren't really core to what we were doing in terms of business-to-business finance. They were consumer and brokerages. And we also exited the regulated space at the start of this year, which I think is a sensible move, considering hard asset and invoice finance are unregulated activities. We've invested in some new people and also brought people through the organisation. So more latterly, we've employed a new head of business improvement. That's quite different from a growth strategy where we were bringing in new managing directors of the division and a new group operations person. The business improvement will be a real key part of what we do in the next cycle, because that will be focused on making the business more efficient through use of systems and improved processes. As we grow, we want to focus on efficiencies as well. We've developed our product offering, so we've put a new asset-based lending product in place. What does that do? Well, it effectively provides the opportunity to lend asset, invoice and loan finance to one company, rather than just being, as I was saying before, a one-trick pony. And that's really important because obviously it provides us with different income streams for the same client, and it means the client generally stays longer with you. And we've continued to build our brand really successfully. We've sponsored the National Association of Commercial Finance Brokers, who most of our introducers belong to. We've won some awards, as I mentioned, and we were ranked number 1 in the Business Money Intermediary Index, whereas prior to that we didn't figure at all. So the business has really made good progress in the last few years. At that point, I'll hand you over to James to talk about the numbers.
Thanks, Ed. Yeah, I'm conscious of the time, so I'm going to go for a real whistle-stop tour of the numbers to enable the time for questions. So our financial year end is to the end of May, so I'm going to very quickly go through the numbers to May, from May 24 versus May 23, and then the same metrics for the Q1 trading update, which we released after the end of August. As Ed said, we're getting quite close to the half year. But what you can see here is a lot of green ticks on the right-hand side, so from a purely financial point of view, the plan is delivering. We've overachieved on everything we said. Our origination up 25%. Why is origination important? Origination is effectively deals that come to us and we write on our own book. So if it's the lifeblood of the business, that those deals will grow the book, and as long as they work as planned, they'll drop interest in every month over the length of the lease or the fees of the invoice finance deal. And if you get the arrears right, that then turns into profit. So it's the front end. It's an early warning or early highlight of how things are going. So origination growing is absolutely key. That grew 25% in the last financial year. That led to the lending book going ahead of 200 million for the first time ever, an 18% growth. So we were providing excellent levels of new business to UK SMEs, the lifeblood of the economy. But as Ed said, the key thing is it's arguably easy to lend money. The skill's getting your money back in. And so arrears and write-offs are absolutely key in what you do. Arrears are just deals that are slightly not working as planned. So they might be a day overdue. Someone may have been on holiday and forgotten to pay us or whatever, all the way through into the legal processes. But they're an early warning indicator of things that could potentially go wrong. As you can see here, year on year, it actually, despite all the macroeconomic headwinds, our arrears improved by 1% to 5%. And then write-offs are the ones that actually, at the end of the day, unfortunately, we weren't able to get our money back. And those fell again by 1% to 1%. So we grew the book, but at the same time, the quality of the book arguably improved, certainly stayed static, if not improved. And that fed through to the P&L. Revenue up 20% to over 30 million, 33.2 million. PBT up over 40% to 5.9 million. And that led to a big increase of 30% in our EPS. And our balance sheet, one of our four key pillars, strengthened the balance sheet, increased 13% to just under £39 million. So a really good last financial year. And that carried on into Q1 this financial year. Again, origination up nearly 10% quarter on quarter. So on the record year before, we're growing on where we were in that year again. The lending book again increased 205 million. And crucially here, sorry to labour the point, but it is quite important, arrears and write-offs stayed the same. So we're growing the business without worsening the quality. That's led to revenue 20% up again. PBT also over 40% quarter on quarter to 1.9 million. And our net tangible assets now over 40 million at the end of August to 14%, growth of 14% to 40.1 million. So really good financial metrics over the last, well, it's actually 3.5 years, growth on growth. A couple of other slides before I hand back to Ed very quickly to wrap up. The lending book is absolutely key. As I said, if we grow the book, that will lead to revenue and profits if it's the right quality over time. And you can see here, left-hand corner, end of COVID, we're about 115 million or so. We set the new strategy in place. There's a few dips for Christmas and Easter and when people are on holiday and things, but pretty much month-on-month growth. It's actually 29 quarters of consecutive growth. Months of consecutive growth, 13 quarters of growth, and we're now over 200 million and onwards and upwards. The graph on the right-hand side shows the arrears. Again, a very key point as we've spoken about, but you can see there the group arrears have fallen from about 12%, and now they've been consistently in the 5 or 6% range for the last 2 years or so. The hard asset and invoice finance ones I've pulled out there as well, because as Ed said, they're the key growth areas of the business. They're secured lending, and you can see there hard asset arrears around about 4%, bit of movement every now and again, but around about 4% consistently for 18 months or so. Invoice finance a little bit lower, around about 2-3% as well over the same period. And finally, we can only do what we do thanks to our funding partners. We need to have significant funding to be able to lend on. We've got a number of long-term supportive funding partners who we work with from the British Business Bank, the government-backed business. We have a £65 million facility with them. RBS Invoice Finance, they fund our back-to-back facility. That renewed since the 31st of August, actually, and is now a £65 million facility as well, rather than the 50 million stated there. So we've just renewed that. A number of other wholesale funders like Aldermore and everything like that. So we're very well funded to fuel the growth, and we think the numbers are bearing out that we're picking the right clients to lend money to, and that's driving the revenue and profit over the period. And with that, I'll hand back to Ed.
Thanks, James. So just by way of a summary, and then there's one slide at the end, which is our investment case. Our plan at the moment is very much more the same, so it's continuing on with the current strategy, business-to-business lending, focused on hard asset and invoice finance, and as you can see, that's where really the success story has started from in terms of that core offering. The medium-term aims remain the same. Strong progress has been made to date, and we've got positive momentum carried into the new cycle of our plan, which will, jumping down to here, which will be a 3-year plan, which we'll look to finalise at the end of this calendar year, early into the new year. We'll continue to focus on our profile and brand recognition to make sure that people understand who we are and we get the right business from our introducers, and the people that we took into the business to bolster various parts are now very much embedded and delivering value. So very much on track from the plan that we set ourselves 3.5 years ago. In terms of the investment case, well, We're very proud that we've got 10,000 customers that use the services of Time Finance. We're lending more and more, as James has mentioned, each quarter, over 200 million now, and we see no reason why that won't continue to increase each quarter. Our profitability, we finished last year at 5.9 million. We set our market expectation at 6.9 million for this year. Last week we put an upgrade out to 7.2 million for the current year, and that follows a number of upgrades from the last financial year. So we're very much trying to build, I suppose, confidence and credibility by under-promising and over-delivering rather than the other way around. That's definitely my ethos. The net tangible assets, if you've seen, have grown month on month. They're now well over £40 million. Our market cap is around about 52, 53 million. We have very well spread lending. It was on one of James's slides, but we flicked over it because of time. The maximum concentration that we have into any one industry, not any one deal, but any one industry, which is transport and logistics, which is a favourable industry for this form of lending. But the maximum concentration is around 13% of our book into one industry. So we have a philosophy which is don't bet the ranch. So if our biggest deal goes bust, we'll have a hit to profits, but it won't send the business, into turmoil. I prefer to sleep at night, and my whole background is from small businesses that are well spread across the book. So that's a key part of the investment case for this business. We have experienced leadership. I'm probably getting in now into the point of becoming old in the industry. We've just brought in some new graduates, so we took in 6 new people, and that's part of our succession plan for the next few years. We've won some awards, and the last point is probably the most interesting: market conditions. So market conditions are really challenging. Small businesses have gone through an awful lot over the last few years, as have most businesses, with interest rates significantly increasing, supply chain disruption through all sorts of geopolitical challenges, inflationary pressures, change of governments, but they're remarkably robust. Lots of commentators have come out and said there's going to be a bloodbath of small businesses that go belly up. That's actually not proven to be the case. Having said that, businesses like ours do really well through boom and bust cycles. We don't do quite as well when it's really nice and steady. We do well when people need cash. We didn't do quite as well during COVID because the government stepped in with loads of COVID loans, which were cheap, and people use those facilities to repay ours. They don't exist anymore. So alternative financiers like ourselves do well in these sorts of times, because ultimately small businesses need access to cash to function day to day, to invest in capital equipment, and to grow. And we think we're well placed to do that now in the independent market, the non-bank market, because quite frankly, small businesses prefer to deal with people who have got a relationship with them. So after all the hard work we've done over the last 3 or 4 years, I think coming into the next cycle, we're really well positioned, and I think the numbers sort of demonstrate that, and there's more growth to come. Thank you very much for listening.
Thank you.
Ed and James there. Now, if you have a question, please raise your hand and wait for the microphone. So Steve's coming down to this row here first, and we'll come back to you, and we'll come back to you. Okay.
Thank you very much for a very good presentation. There are 2 things I like in small businesses. One is dividends, and the other is directors with skin in the game. You're not listed, neither of you are listed as one of the 3 key shareholders in the business. Could you comment on your personal exposure and also any future plans you have for a dividend distribution?
Sure. I'll do mine, and then James can obviously do. So we do have shares. I've bought shares. My wife's also bought some shares in her name. I've got a share option scheme, which is into it the 3rd year of 3. So I do have shares in the business. Obviously, it's not at the level of the 3 main shareholders. They're quite significant. And James has got shares, and he's purchased shares in the business and had a previous share scheme as well. In terms of dividends, so I've been very open when I've been asked this question in the past, and I say it openly whenever we do a forum like this. At the moment, this is a growth stock. It's not a dividend-paying stock. That may change in the future. We need to use the cash that we have available to grow the business. The board regularly have it on the agenda to determine whether that should continue as a strategy or not. We last discussed it last December. We're due to discuss it again this December. My own view is that we should continue to stay as a growth stock rather than a dividend stock, because the more that we can use our cash to grow the loan book, obviously the model of the business means that the more we'll grow the profitability as well. And being perfectly honest, if you want a high dividend paying stock, go and invest in Lloyds Bank, would be my message.
Thank you for that advice. I'll have a look at Lloyds tomorrow.
Can you pass the microphone over one? Yes, please. Thank you.
It's a great presentation. Thank you. I just wanted to ask you about asset finance side. When you mentioned about soft assets and hard asset, I can get the heads around a little bit on hard asset, and how do you value hard asset, and what kind of things there? And if it is soft asset, what are the kind of soft? Is that intangible?
Yeah, so soft assets can range from a lot of things, but one of the key markets for the soft asset industry is hospitality.
Okay.
So if you go into a bar, pub, restaurant, they have lots of things in there that'll be on finance, and that could be literally the tables and chairs to coffee machines, ovens, catering equipment, lots of stuff like that. But it can also go into sort of things like optical equipment, hairdressers, salons, garages, things that effectively, when you use them, they don't have a residual value at the end of the lease. The key point is in the soft asset market is that they're business essential pieces of kit. So if you fund a piece of kit that may not be that desirable, it's generating income every day. So a coffee machine may sound like not a great asset to fund, but if you've not got a coffee machine in a coffee shop, you're not going to be able to function. So they've got an incentive to keep paying you their repayments each month, because quite frankly, if you're going to take that coffee machine away, they haven't got a business. However, as you've seen by the graphs, we've moved quite a lot away from the soft asset market because we believe that the hard asset market is more secured lending. So if you have a problem and you're going to pick a JCB up or a crusher, something that's got 50 or 100, 150,000, I mean, some of the cranes that we finance that you see on big building sites are £500,000 more. So those big pieces of kit have a residual value, and there's a resale market that you use agents and valuers and third parties to help you recover and then sell on.
How do you actually do the valuation on those?
So we use third-party valuers, professional valuers, and they have links with auction houses or other suppliers who can then move those goods into their customers.
A question here, please, sir.
Yes, just a couple of questions. Firstly, to what extent can your return on equity expand as you scale up? And secondly, if you could just a little bit more about the process you could do to control which businesses or assets you would lend to and what sort of stuff you would turn down. And that's obviously particularly important in the current outlook.
Do you want to take the first part, James?
So what's your return on equity? Was that the question?
Your return on equity is currently about 12 or 13%. To what extent could it go up as you scale up the business?
We think that we can get it into the high teens over the coming years. That's our aim. So it's quite vague, quick answer. But
what would help it scale up? And will your cost of finance go down? Will you get?
We don't. I think we think we're pretty well funded in terms of the cost we pay. Without being a bank, we're getting as good a rates pretty much as you can out there. We think on the market, and the independent reviews we've had of our funding structure and everything like that has backed that up. We've had three done in the last 18 months. So we think we're getting pretty much as good a margin in terms of our funding in as we possibly can. In terms of, but that does give us quite a bit of firepower to grow. Our focus, as Ed alluded to, is particularly on business improvement. So as we grow now, we think we can do it more efficiently in terms of primarily staff. We've got a de minimis level of staff that we think with improved efficiencies and things like that, we can grow. And apart from sales staff, we shouldn't be increasing the back office. So that's where, when staff costs are your biggest cost in reality, if they're growing far slower than your revenue and your origination and everything like that, our margins should improve quite significantly.
And the procedures for controlling, as I say, which assets and businesses you would lend to and what you would turn down?
So we use, as you'd expect, we use a combination of a human experience and credit knowledge, and also systems. So we obviously have access to lots of credit data, credit agencies. So we check out obviously the ratings of the businesses, the people behind it. We use third-party valuers, as we said, but we also use reputable suppliers. So that's an important part of the sales process. If you're dealing with a one-off supplier who could be in cahoots with somebody to effectively create fraud from goods that aren't even delivered, and you're funding them and then the people just disappear, which can happen. So reputable suppliers, but we're very much a people business, so we rely on getting the right people in the business with the right experience, the right contacts, to make sure that we have the right credit policy. And all these things are documented and people have to adhere to them. But yeah, it comes back to a mixture of credit reporting, data and experience.